We're going to talk about mortgages. And, most people understand the math behind a mortgage, right? You figure out your after tax interest rate and you look at the risk free rate in the market, what you can go get in a CD or in a high yield savings account or a money market fund. And you go, well, if I can earn more elsewhere, maybe I shouldn't pay off the mortgage and I should carry it out. That's the way the math works, right? If you can make 5.3% in the Vanguard money market fund and you're paying 2.5% on your mortgage, you can make a mathematical case for dragging out your mortgage, at least for a while. Most mortgages coming out today are 6 and 7%. So you can only make 5% in the money market fund. It doesn't necessarily make as much sense to drag out your mortgage right now if you've just gotten one. But if you picked one up during those low interest years, you can make a mathematical case there. But there's a few things I want you to think about, particularly if you're relatively well to do. Some reasons why you might want to consider paying off your mortgage early. The first one is that if you're wealthy, you're probably maxing out your retirement accounts. So you are now comparing investing in a taxable account to paying off the mortgage, right? I mean, if you can max out another 401k or Roth IRA or something, well, that's often a better use of your money than paying off a mortgage. But now you're investing in a taxable account, right? There's going to be tax drag on that, particularly if you're investing in lower risk stuff. It may not come out ahead of what your mortgage is, and you might be better off just paying off that mortgage. Another thing that higher earners have to deal with is higher tax rates, right? We mentioned this on the podcast, right? They're putting 30% of their money toward taxes, and that's probably what they're actually paying on a two-physician income in California. They're probably paying 30% of their income in taxes. And every additional dollar they make is probably 50%. That's just the way the progressive tax brackets work. But the higher your tax rates, the lower the actual after-tax yield is going to be on your taxable investments. And so that makes it more likely that paying off your mortgage is going to be the right move in comparison. Okay, another thing that the wealthy deal with is that there's a lower marginal utility for extra wealth. Now, this is an economic term, right? Utility is like the benefit from having more money. When you're very poor, a little more money makes your life a lot better. When you're pretty wealthy, a little extra money doesn't make your life dramatically better. And the more you have, the less marginal utility of investing at 5% and paying debt at 3% is going to give you. It just doesn't move the needle after a while. And so you're more likely to simplify your life, pay off your mortgage, etc. All right. Another reason why it can be beneficial to pay off that mortgage early is it's kind of a little bit of a luxury good, right? I haven't had a mortgage since 2017. So what's that? 7, 8 years now. I never have to make a mortgage payment. I don't have to worry about it. I don't have to worry about the bank coming after my home. My house is paid off. I get to brag to you that I have a paid off house, right? It's a luxury in some ways, but in a lot of ways, it's the ultimate luxury good. It's the ultimate status symbol, paid off mortgage. No, I don't drive a Tesla. I did rent a McLaren, but I don't drive a Tesla. I don't drive a sports car regularly. But I got something that's maybe in some ways a little more of a status symbol. I don't have a mortgage. Okay, another thing that debt gives you inflation protection, right? If you have fixed rate debt, especially at a low rate, right? Let's say you got a mortgage at 3% and inflation goes to 9%, like it did a couple of years ago. Well, you're now paying back that debt with deflated dollars. That's some protection. But you know what? The opposite happens too. If there is deflation, right? You start earning less, your money's worth less, etc., or your money becomes worth more. Well, you still owe the same nominal amount on your mortgage, right? And so paying off that mortgage actually gives you some deflation protection. You lose the inflation protection of having the mortgage, but you get deflation protection. Now, while deflation is not as common as inflation, it's not like there's no value there. And finally, one reason why it can make sense to pay off your mortgage is if you are paying advisory fees to a financial advisor, right? If you're paying an asset under management fee, they're generally not including the value of your home, right? And so if you had, $500,000 in a taxable account that they're managing, you're paying them 1% a year, that's $5,000 you're paying them for that money. Whereas if you took that $500,000 and put it toward your mortgage, it comes out of the assets under their management. You're no longer paying fees on it. You just saved $5,000 in fees. And that makes it so the break-even calculation's a little bit different. Now, obviously, you got to run the numbers. You got to see what your goals are. You got to decide how much leverage risk is worth taking. You got to decide what your goals are, when, if ever, you want to be mortgage debt-free. But keep in mind that there are lots of great reasons to pay off your mortgage, even if it's possible to earn more than your mortgage rate on your investments.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.